All right, now we're going to be talking about supply side economics. So the concept with supply side economics is that by increasing the short run aggregate supply, that will lead to an increase in quantity without increasing the price level. And here's a graph that shows you what I mean. So if we are originally at this level of short run aggregate supply, and there are policies in place aimed at increasing the short run aggregate supply, then we move from P1 Q1 right here to P2 Q2, where we have higher output, but our price has either gone down or has not changed at all. Okay, so supply side policies are aimed at increasing aggregate demand by increasing incentives to work, save, and invest. So what kind of incentives do you need? Well, for example, when the government instituted the write-off for the 401k or the IRA, that is an increased incentive to save and to invest. So anything like that, for example, if the personal tax rate was reduced, that would increase your incentive to work more because you'd be able to keep a higher percentage of your money. So those are supply side policies. Okay, I'm going to touch on the Laffer curve. The Laffer curve ties into the tax rate in a very important way. So the Laffer curve gives the relationship between the marginal tax rate and the tax revenue. So remember that the marginal tax rate is the tax rate paid on the last dollar earned, different than your average tax rate. And then the tax revenue is the amount of revenue that goes to the government from the taxes. So at every point here, you could see as the marginal tax rate increases, the tax revenue also increases. So if you were here, you'd be making this much. If it's raised to here, the government would be making this much, or they'd be collecting this much. But when you get to some relatively high tax rate, and that is called T star, and this tax rate is different for everyone. But once you get here, see right here, if this is the tax rate, and then if the government raises the tax rate again, they'll actually collect less money. And the reason for this is because that increases the incentive for people to engage in legal tax avoidance or illegal tax evasion. And the tax revenue will fall as the tax rate goes up. So this is a cautionary tale to governments that you cannot overtax the people, because eventually your tax revenues will fall. So now we're going to talk about the tax rates. So the marginal tax rate, like I said, is the tax rate that you pay on the last dollar earned. So the United States has what's called a progressive tax system. So as your income goes up, the percentage of tax goes up along with it, and your tax is basically broken down. For example, $0 to $20,000 is exempt. You don't pay anything. And then the next chunk of money, and I'm making this up, this isn't the correct numbers, but say from 21,000 to maybe 32,000, you pay like 19%. And then from 32,000 to 42,000, maybe you pay 21, and so on and so forth, where you max out. The top tax rate, I believe right now, is 39%. So that's your marginal tax rate. And the way to figure this out is the change in tax divided by the change in income. That differs from the average tax rate, which is the entire amount of tax you pay divided by your entire income. And that is the percentage of income paid to taxes. The average tax rate is going to be less than your marginal tax rate. So for example, if your income is $10,000 and you pay $1,000 in taxes, when your income is $20,000, you pay $2,500 in tax. So at Y, which is income, equals 20,000, your tax liability is 2,500. So your marginal tax rate is the difference, the change. So remember that the delta means change in, the change from the tax rate, which is 1,500, divided by the change in the income, which is $10,000, so your marginal tax rate is 15%, but your average tax rate is the total tax that you paid divided by your total income, which is 12.5. So supply side focus on your marginal tax rate. Supply siders will argue that lower marginal tax rates increase the incentives to work, save, and invest, which increases aggregate supply. So I'm going to just really quickly go over taxes and the national debt. This kind of stuff is sort of nice to know, but not really need to know, but it is interesting. So the major sources of revenue for the federal government: personal income tax, corporate income tax, and Social Security tax. The tax structures: progressive, regressive, or proportional. The United States operates under a progressive tax system, meaning as your income grows, so does your tax burden. Regressive would be the opposite. The more your income grows, the lower the percentage that you pay on each additional unit. And proportion would be a flat tax. So flat tax proponents have done studies that show that if there was a flat tax, then the government would actually collect more money. And you have to ask yourself, why do we not have a flat tax then? So you go down that hole of who benefits from our current tax system, and you just think about everyone who benefits from the United States having a really complex tax system. So that would be the tax attorneys, the tax accountants, H&R Block, and all of those types of places. So those people, and also the IRS, would lose out if we had a proportional or a flat tax system that everyone could understand. So I think this is a great idea, but I don't think we're ever going to see it. So we've talked about the major sources of tax revenue. What are the major spending programs? Number one is Social Security for retirees. Number two is the national defense. Then we have income security, which is assistance to the poor, disabled, and federal government retirees are here. Interest on the national debt, that has grown to be a huge, huge burden. Medicare is for Social Security beneficiaries, and then health other than Medicare. So this would be Medicaid. So let's talk about the deficit and the debt. So the deficit is the amount in any given year by which government spending exceeds taxes, whereas the debt is the total amount. All of these deficits added up, that's going to be your debt. So the debt is the total amount the federal government owns its creditors. It is the stock of outstanding government securities. All the bonds that are sold, that represents debt. So we can have cyclical deficit. So that results from an economic downturn, just like cyclical unemployment. We can have a structural deficit. That is a deficit that occurs during full employment. And then we have the total budget deficit, which is cyclical plus structural. And why do we care so much about the debt? Because the burden of debt is passed on to you. So who owns the debt? Government-held debt accounts for about 40%. That means that different departments within the government own the debt. So, for example, the Social Security Administration owns a lot of the debt. Compare that with public debt. So about 60% of the debt is held by American businesses, so insurance companies, etc., individuals, and foreign entities. So yes, you could go down to the Fed and you could buy a U.S. Treasury bond and you would hold some of the debt. So does the current generation bear the burden, or does the future generation bear the burden? If current resources are devoted to public use and those resources are not available for consumer spending and business spending, then that is a redistribution from the taxpayers to bondholders. So foreign debt plays a burden on future generations, which is you guys. So a different way to put it is that my generation, the current generation, voluntarily, lends to the government, and the government debt is a savings vehicle. However, future generations must pay off these bonds with no voluntary decision to do so and with no gain in the purchasing power. So what that's saying is that every generation is basically pushing that debt to the next generation, and at some point it will need to be paid. Are there benefits to this debt? Some might say that because debt finances public works, education, welfare, etc., future generations would be better off and stand to benefit the most from this public debt. I personally think that debt needs to be paid down to a reasonable level, and we should expect the government to handle the finances just like we handle our own. So that is it, and in the next segment we will talk about money banks and the Federal Reserve.